I'm Justin Boyd, President of Delta Financial Advisory, a registered investment advisor. We provide wealth management and investment advisory services grounded in an unbiased analysis of the economic landscape and financial markets, combined with a holistic approach to financial planning. Welcome to our special topic video series, where we'll explore a variety of pertinent topics to the economy and markets, as well as household wealth management. If you'd like to learn more about Delta Advisory, please visit our homepage at deltafinancialadvisory.com and complete the contact request form. If you find value in today's content, please like this video by clicking the thumbs up icon and consider subscribing to our channel. Okay, let's get started. Today, we'll look at private credit, an asset class that has seen considerable growth over the past decade and particularly the last several years. What is private credit? And what impact could it have on the broader financial markets and economy? Private credit generally refers to financing provided by non-bank financial institutions that operate outside of the heavily regulated traditional banking sector. Businesses with revenues between 10 million and 1 billion are the most common recipients of this financing and often do not have efficient access to public debt markets. It should also be noted that a very large portion of these loans are extended to businesses backed by private equity funds. Let this be your first indication of the often interrelated nature of private credit with private equity and the traditional banking sector. Additionally, the viewer should be aware that private credit as an investable asset class really came about after the Great Financial Crisis, particularly due to the increased regulation with the passage of the Dodd-Frank Act. Private credit has presented significant competition to traditional bank loans, as the speed of underwriting and flexibility in terms often make private credit a more attractive option. However, it's important to recognize that a large portion of these loans also would not or did not meet the higher underwriting standards and lending covenants of traditional banking. In other words, higher risk, higher reward is often an apt description for this new asset class. Due to the more private nature of these transactions, analysts and regulators both face increased challenges in evaluating these instruments and their possible impact on financial markets. The total market of existing private debt is approximately $2 trillion, with some estimates that the industry could almost double through 2028. 75% of the total market is now focused on the United States. The primary investors in the market are specialized credit funds and asset managers, as well as pension funds, insurance companies, high net worth individuals, and even sovereign entities. Approximately 2/3 of the current market is comprised of straightforward term loans of intermediate duration, around 4 to 5 years in maturity, while the balance are more nuanced products with greater implied risks involving a hybrid structure or revolving nature. Before progressing any further, I'd like to outline the positive features of this market to present an unbiased picture of the potential for structurally higher returns in this market for years to come. First, the majority of these loans are senior secured, the highest position in the capital stack for investors to recover their funds in the event of bankruptcy or restructuring. Second, they are originated by entities with lower regulatory cost burdens and therefore can offer more competitive, efficient, and profitable arrangements for all involved. Third, many private credit funds have general partners with significant skin in the game. So limited partner investors are likely justified in taking considerable confidence in this arrangement. Lastly, private credit loans have experienced relatively low default rates when compared to other speculative debt instruments traded on the public markets. All of these positive aspects could continue to support this lucrative market for years to come, assuming everything generally goes well and as planned. I suspect for many private credit participants, this could certainly be the case. However, as an objective analyst, fiduciary to our clients, and experienced market participants, we always remain vigilant for money flows or status quo beliefs that could ultimately prove false and place client capital at risk. It's my opinion that private credit meets this criteria for caution. To understand the growth of private credit, we need to step back to the Great Financial Crisis surrounding the 2008 timeframe. There's an excellent report created by the Brookings Institution and the Yale Program for Financial Stability that I'll reference on several occasions to provide some impactful references and establish the timeless links of financial behavior to today's private credit market. The report highlighted many critical elements of the crisis, and we'll focus on several today. The most critical of all is this. Prior to the GFC, credit and risk had migrated outside the regulated banking system. This is the most high-level and critical element to understand for today's market participants. Despite the regulations, FDIC reporting, internal and external audits, financial innovation still found a way to ultimately create a crisis. How was this accomplished? Amongst other things, through innovative accounting techniques involving special purpose entities and special purpose vehicles designed to obscure or outright sidestep existing financial regulation. The goal was to remove reportable risk from bank balance sheets and obscure the presence and nature of these assets from general knowledge. Let's fast forward to today. Post Great Financial Crisis, the Dodd-Frank Act addressed a multitude of regulatory failures, and we now receive regular reports on how banks have passed their stress tests, have healthy equity and Tier 1 capital ratios, as well as Basel III regulations being phased in, which should aid in further banking sector stability and transparency. So what is there to be worried about? Simply put, the timeless nature of financial innovation and profit seeking. Similar to the structured products that wreaked havoc during the GFC, banks and private entities are now engaging in similar transactions and debt structuring techniques with the specific intent to manage their capital for regulatory and operating requirements. So what does manage regulatory capital really mean? In this case, the riskiest assets are effectively being removed from bank balance sheets or insured against to facilitate higher regulatory capital levels, thereby increasing lending opportunities elsewhere and lowering the capital costs to these institutions. At a high level, these are referred to as SRTs, or synthetic risk transfers. But the actual agreements to carry this risk transfer out are typically credit-linked notes, otherwise known as CLNs, and credit default swaps, or CDSs, as well as securitization, or the pooling of similar loans packaged as securities for sale to investors. The specifics of these products can be sophisticated, and considerations for a reasonable length video today prevent an in-depth analysis on that specific topic. However, the end result is that net leverage in the system as a whole is further increased by the use of these products. While guidance provided in September of 2023 by the Federal Reserve makes efforts to contain the ultimate exposure of any single institution to these instruments, should aggregate loan quality or general credit conditions deteriorate, significant problems could quickly ensue. Meanwhile, more complex and aggressive products continue to be introduced into an increasingly competitive and saturating market. Moreover, if this were caused by or led to a larger lack of liquidity or genuine concern for solvency of any of these large private institutions, the Fed and Treasury may once again have to step in and provide last resort lending and credit creation. Certainly, this would be expected if the traditional banking sector were materially impacted. You might be thinking, this all sounds possible, but what are the chances of this actually happening? No one has the exact answer as to the probability of a crisis related to these instruments, not even the Treasury or the Federal Reserve, per their own proprietary research. For immediate context, let me provide some direct quotes from a 2024 report issued by the Federal Reserve itself on the risks of the private credit market. Quote, private debt funds have attracted highly leveraged borrowers that are unable to get adequate funding from heavily regulated banks. Scarcity of available data has made it challenging to assess risks in this market. Recent deals are devoid of financial maintenance covenants as private credit managers look to compete with banks in the large corporate market segment. The report goes on, quote, first, banks are increasingly partnering with private credit funds to fund new deals. Second, banks are progressively selling complex debt instruments to private fund managers and so-called synthetic risk transfers in order to reduce regulatory capital charges on the loans they make. Such instruments have limited transparency and pose hidden risks to the financial system, especially as the industry has yet to endure a prolonged recession. A second report, issued by the Congressional Research Service in 2024, also has colorful commentary that market participants should be aware of. Quote, "It has been difficult to obtain reliable data for market-wide risk assessments and systemic risk monitoring. Given the increased size of private credit and its interconnectedness with banks and other non-banks, its own risks could spill over to others through channels such as credit losses, capital calls, and leverage. Even private credit funds with modest direct leverage may still experience multiple layers of leverage at borrowers, investors, and special purpose structures. Asset valuation for illiquid private fund assets tends not to keep pace with the deterioration of valuation losses during downturns. This could lead to sudden markdowns that may amplify the tightening of credit conditions, especially in stress scenarios." Another interesting source of information on the topic was a recent Bloomberg article highlighting modern and evolving techniques to truly value the performance of private funds. In fact, the leader of this effort, around which the article was written, is actually the former head quantitative analyst at the third largest private credit fund operating today. The essence of the article is that the lack of transparency makes efficient and liquid valuation of private investments quite challenging. This is right in line with the findings of the Federal Reserve and Congressional Research Service, and anyone who has participated in these markets. However, the article went on to quote another industry quantitative leader who described the results of status quo valuation practices as, quote, volatility laundering, which in context really meant volatility dampening. While this may seem like a mostly academic exercise during times of financial stability, during times of crisis, the nature of these investments could turn extremely problematic very quickly due to the exact characteristics which often make them attractive most of the time. Increasingly speculative behavior in this asset class with increasingly large dollar amounts could ultimately lead to significant financial trauma for these market participants and the broader financial system at large. What's the ultimate takeaway from this video today? With public equity indexes at all-time highs and credit spreads at or near historic lows, even a reasonable-sized market difficulty could cascade into the next trigger for significant asset price declines, and certainly if this unforeseen event were large enough to ultimately require lender of last resort intervention. As such, every prudent market participant may want to consider if a full or overweight allocation to risk-on assets is the best long-term investment decision presently, given their own unique circumstances. Our intent here is not to sensationalize the potential risks associated with SRTs or to suggest some sort of imminent occurrence surrounding private credit. Rather, as a dedicated fiduciary, this type of unbiased analysis of the possibilities is what we do every day here at Delta Financial Advisory. If you think our approach may be a good fit for you or a portion of your larger portfolio, contact us by visiting our homepage at deltafinancialadvisory.com and submitting a contact request form.
Disclaimer. The information and commentary contained in this video are for general informational purposes only and do not constitute financial, investment, or other professional advice. The views expressed are strictly those of the individual and do not necessarily represent the opinions of the firm. Always consult with a qualified financial advisor before making any investment decisions. Investments carry risks, including the potential loss of principal. The content is based on current market conditions and is subject to change without notice. The firm is not responsible for any errors or omissions or for any actions taken based on this information. Past performance is not indicative of future results. This material does not constitute an offer or solicitation to buy or sell any securities.